What's going on, guys? It's David Piatek, and today I'm going to be talking about locking interest rates. It's a question I get all the time, so I'm going to break down when an interest rate is locked, what happens if there's changes, how a interest rate can change, because all these things affect your affordability for purchasing a property. If you guys don't know, I am a loan officer and able to help you utilize that amazing VA home loan. You can schedule a call with me down in the description below. So let's talk about the interest rate itself first. So the interest rate fluctuates all the time, sometimes even a couple times a day. That's one part. The other part is that when you are pre-approved and going through the pre-approval process, typically an interest rate is not locked in until you go under contract. So rates may go down during the time that from the time that you get pre-approved, or they may go up, right? So up and down, just really depending on where the market is. That's why it's so important that when you're getting close to making an offer you reach out to your loan officer if it's been a hot minute and ask them, hey, where are current mortgage rates for my situation? And it's very important to understand that your situation is going to dictate the interest rate, because an interest rate is made up of a couple of factors, right? It's going to be your credit score. Are you putting a down payment? Yes, even with a VA loan, it can change your interest rate. It's going to be type of property, right? Are you purchasing a single family condo, multifamily? What are the price points? Is it a regular VA loan? Is it a jumbo VA loan? All of that is going to make an impact on that pricing. But what I encourage you to do is that when you are go through the pre-approval process and you're pre-approved, ask your lender, hey, where's my current interest rate? And just double check, like, hey, can this interest rate change or not? Now, let's fast forward a little bit. Once you go under contract, at that time, you have to make a decision. Do I lock my interest rate at that time, or do I float my interest rate? And what floating an interest rate means is that a lender's going to let you know, hey, based on today's pricing, this is what the interest rate is. This is what the buy down, if any, like buying down the interest rate, and any origination fees they may have. They send you a loan estimate, right? And it breaks all of that down in there. But what I look at a lot of these as well, where I see that a lot of loan estimates are not locked. And thanks to you guys on YouTube reaching out to me and saying, hey, David, can you review this loan estimate for me? Or even closing disclosure. And I'm like, hey, they're charging you way too much. We could do a better job and get you lower fees or better interest rate, whatever. So you guys can always reach out to me just to get a double take on that. Because I mean, this is what I love doing, and I can help you across the country. So, we'll take a look at that. And what happens if an interest rate's not locked in is those discount points can change, okay? And that's what you don't want to happen, right? When we see that a lot where someone's like, oh, well, my interest rate, I got the same rate, but they charged me higher fees. And that's most likely because rates went up and then they wanted to keep you at the same rate so that discount points get affected. Now, let's talk about what happens if you lock the interest rate, okay? So a couple things. And I guess this is kind of on a broader scale too, because interest rates can technically change once you lock in your interest rate, right? And also how long you lock your interest rate for is going to impact the pricing. So let's go over those two things. So one, you normally see like 30, 45, 60, 75, sometimes 90-day locks, okay? So every lender is going to have kind of a different appetite for what those lock terms look like. Typically, right, from my end, we normally recommend just doing a 45-day lock, even if it's a 30-day closing, even if it's a 20-day closing, because a lot of things can happen. And normally, there's not much of a price adjustment between a 30 and a 45-day lock. Once you go past that amount, then typically you're going to see a large pricing adjustment. What does that mean? That normally means that if you're trying to get, let's say, a certain rate, and on a 30 and 45 day, you can get that rate without doing buy downs, let's say. But if you go to a 60 or 90 day, you could be talking about higher fees to be able to get that, or your interest rate would be higher. The reason that exists is that because, especially in today's market where the market is shifting so fast, normally it's higher risk to do longer locks, right? So because rates may shift where they go down. Now lenders will be canceling those locks and then relocking them with different investors. That's what happens on the back end. And what used to be really popular back in the days, you could do what's called a lock and shop. I don't know of places that offer that anymore just because of the market volatility, but sometimes you're able to lock an interest rate a year for an entire year. But again, just based on where we're at right now, I don't really see people offering that right now. So the lock period is important. Okay, that's one part. The other part where an interest rate can change after you've locked it, and this normally happens with the type of property. And so when looking at a contract, unless someone specifically tells you like, hey, this is a single family home, this is a condo, or this is a manufactured home or modular home, those things can change what the pricing of a loan is, right? So that's why sometimes you may be going through a transaction, and let me know if this happened to you. You might be thinking you're buying a townhome, which isn't a type of loan, right? That's a construction style. It has to either be a planned unit development or a condo. Planned unit developments typically have the same pricing as single family homes, where condos will have varied pricing, meaning that's going to be normally higher premium because they're higher fees and rates, just because typically they're considered higher risk, just like multifamily. But you'd be surprised sometimes if an investor is trying to do more condos or more multifamilies, they actually may offer better pricing for those type of products. That's why it's so important to know. And actually, where you buy in the country may also impact pricing, because some states will charge additional fees to originate loans. It's kind of crazy. We recently learned that, and I was kind of taken back by that piece of that. Now, so we've talked about a couple of things, right? How can interest rates can change, the lock period, property type. Now, also in the transaction, you can have where your credit will expire. So let me touch on that, because that is something that can come out of the blue, and you may be happy or you may be not. And it might work for you or it might work against you. So when you have your credit reviewed, right, by the lender, it's good for 90 days. And after those 90 days are up, right, from a pre-approval perspective, they're normally supposed to pull a new credit report, and so then you can keep looking. But what happens, let's say it's been, I don't know, let's just say it's been 80 days and you just went under contract, right? And your closing's in 20 days. So a lender should to say, hey, look, credit's going to expire in 90 days, within 10 days of you going under contract. Let's go ahead and pull a new credit report before we run the application. Why is that important? One, your credit scores might have updated. If they went up, it may work in your advantage. If they went down, it could be a disadvantage. And what you don't want to happen is that you get to closing, or like you're a couple days out from closing, and then they're like, oh, the credit is expiring. We have to redo everything. And that could delay your closing further down. So I would say if you're 30 days from having your credit expire, and even though you may be closing in 30 days, I advise from experience that you want a new credit report to be reviewed, right? Just ask your lender. Go ahead and pull a new credit report so we don't run into any issues down the line. Lenders will also do soft credit checks before closing. Typically, they do them. And so they can see if your credit profile has changed in that process. If there's a dramatic enough change, then they could do the same thing. Hey, we might have to pull a new report, see what the new scores are, especially if you were late on something. Okay, so don't try to hide that. And that's why it's so important during the home buying process that you actually review and maintain your credit score. And don't buy anything unless, I'm not saying don't buy anything. Don't buy anything big. Like if you're like, hey, I'm going to buy a car, speak with your lender. Sometimes, a lot of times it may be okay. We've done it plenty of times for folks that maybe PCSing from across the country, or, hey, I'm moving somewhere. I'm moving out of the city. I don't have a car right now because I don't need one, but I need to get one. Hey, walk me through that. Always recommend getting just as low of a car payment as you possibly can, because cars are definitely home buying destroyers, because car payments are pretty high and they affect what you can qualify for. So we've talked about a couple of those things, right? Where what can change during that process and what you need to be aware of during that. There are also something that's a bit more complicated, but I'm going to explain it to you because it's important to understand the back end of how things work. Because a lot of times when you're looking online and you're thinking, well, just the interest rate and that's it, right? And with VA loans, it's kind of like a magic show, okay? And let me know if you agree with this. You see a lot of these advertisements everywhere you go, right? And the click through costs of these leads. That's why we don't do any of that. It's crazy expensive. And like I talk about in all my videos, if you're getting marketed to online, you are contacting that company and you are paying for the own marketing because they're charging you extra fees to make up for that. That's just the reality of the situation. Okay. So when you are going through that process of shopping for a lender or you're looking online, again, you can reach out to me. I'm happy to help you. I can help you across the country. Always love working with veteran myself. And you gain all the same knowledge that I talk about in the videos, but it'll be tailored to your specific situation, which is very important to know. But with this magic that they have, right? They show you these shiny interest rates. But a lot of people don't look at the little asterisk that's next to it, then leads you to the bottom of the page in very small writing that says, oh, by the way, this shows like 3 points and $24,000 to get this interest rate. And veterans get sold to more often than not with these mortgages and paying more fees than they have to. I see this all the time, and I think it's crazy. And you can just look at the monthly report that's issued by the VA and how many VA home loans are generated. I know the companies because I look at their loan estimates all the time. And veterans get charged like over $100 million extra in junk fees from my calculations a month. But you don't have to. But again, that's all into the marketing costs of everything that goes on. So you got to be really aware of that and that process. So hopefully you guys got some really good takeaways from the video. Drop a comment down below, like the video, share it with other veterans in the community, because the more information we get out to the veteran community, the better we can help each other.